Good evening and welcome to Money Matters. My name is David Ebner with Merrill Lynch, and with me this evening is Charles Shields with Wells Fargo Advisor.
How you doing,
Charles?
David? Good to see you.
Great seeing you. Charlie, there's a lot going on, obviously, in the investment world, and we've talked about it, and we have one of our viewers to send in a question. So I thought let's talk about his question, and we'll go from there. And this is Roger Wade from Merrill. Roger says, as to research when buying a new company, what are the top 3 items you look for?
Well, there's more than 3 things that I look for. I do try to do my homework, but one of the things I like to look for that we can explore is entry barriers. If someone has a really interesting new product, but they don't have any patents, they don't have any way to protect it, and if they're competing with large companies, then their competitor can just come right in and do the same thing. So do they have a patent? Do they have some way that they've just got themselves so well established? Think back to Xerox in their prime, where you'd say, I'm going to go Xerox this, you know, where everybody has it in their mind that they are the 800-pound gorilla. An entry barrier is really an important thing. And I think price to earnings ratios are a useful tool, but then you have to go into that particular industry. If it's a cyclical thing like automobile companies, you don't expect them to have the high price to earnings ratios that, say, really good technology companies have.
Sure.
So price to earnings ratios can be used as a tool if you know what you're talking about. And of course, management. Are there people that are coming into an industry that have spent years and years doing it and know a lot about it, and they have a well-rounded expertise, they have a good strong team and a good bench? So those are 3 areas, but there's a lot of others also. How do you feel?
Yeah, I agree with you, Charlie. I think there's obviously multiple levels you should be looking at, Rogers. And I think when you're building a portfolio, you really should look at the competition and not necessarily focus on one company. Should I buy company A? Maybe you buy company A, B, C, and D, because it seems in the world we live in today, no company is the standout anymore. We have, 4 and 5 companies. I'll just use, telecommunication as an example. Everyone doesn't use Verizon.
Right.
We use Verizon. We use AT&T. There's Sprint in there. There's Vodafone if you go international. So there's lots of different companies you use. So I think that when you're building a portfolio for investment purposes, Roger, you really should look at multiple companies in a sector, in an industry. But it's also good to get the leaders of those sectors, as opposed to just building a portfolio around the young and up and coming investment.
Sure, and if you have a sector that looks like it's a commodity, let's take utilities for example, then maybe you want to use an ETF there.
You buy the
and if
whole
there's
sector.
a sector that you work and live in and you know and understand the companies in that sector, then maybe you'll want to buy individual stocks in that sector with the help of a financial advisor and all that sort of thing.
Yeah, no, it's great. That's fantastic. Great question, Roger. And if you have a question, please send it to us at Money Matters, 205 East Levering Mill Road, Ballycumwood, PA 19004, or moneymatterstv@gmail.com. Now remember, our shows are taped, so before taking any of our advice and executing on it, please consult your financial advisor or tax advisor, and we'll have an expert answer the question that you send in. Well, again, we talked earlier, a lot of stuff's going on in the financial world, and in your career, you've seen a complete change in financial service, and more specifically, the financial advisor's role. I'm sure when you got into this business, you were really just a stockbroker, right? And then you kind of changed from that. Why don't you tell us a little bit about the history and what the financial advisor does for clients?
Okay, well, maybe I was different than some people in our industry. I had been an investor for 25 years or so. When I was in the Navy, I was interested in the markets. And I noticed sometimes I'd get really good service and I'd get good help. And sometimes I'd find out later that somebody had put 4 points in a bond when they sold it to me. And so I thought there's a really good place in this industry for a guy or a gal who wants to try to keep the costs reasonable, tries to make sure that what they're doing is the right thing for the client. And so I came into this knowing what I wanted to do after 25, 26 years of doing something different. And I just hit 24 years doing this, and I hope I get to do another 20 because I love what I do. How about you? Give me a perspective on how you came into it.
Well, so it's interesting. So I came in kind of after the stockbroker, when really everything was transitioning to fee-based and planning-based. And I've always thought, I remember when I first interviewed in the industry, I interviewed with, my friend told me, the only companies worth interviewing are Smith Barney, Merrill Lynch, and Goldman Sachs. So I interviewed with all three of them, and they all offered me a job within a week of each other.
Okay.
And I selected Merrill Lynch because they were more financial planning based.
Mm-hmm.
They really were ahead of the curve on the financial planning. And I think that people aren't interested in, your investment stock idea or your bond idea or your mutual fund idea or whatever. They're really interested in the holistic view. How's this going to help me put my kids through college? Mm-hmm. How's this going to help me buy that vacation property? How is this going to help me live through retirement without worrying about money, right? And then what am I going to leave to my kids? So I really saw our role as, we're able to help people with very complex things, but we're able to look at everything holistically as opposed to looking things as most people look at their finances in these little silos.
All right, well, let's just suppose there's a viewer or listener out there who's undecided whether they should be at Vanguard or use a financial advisor. Just talk to me about a few of the reasons they should consider using a financial advisor.
Yeah, so it's interesting. I think Vanguard and that's a great example of a company who clearly focuses on the investment and keeping their fees low, right? Mm-hmm. But there's no advice. You call them up and there's no advice. They don't care if you invest in their equities here in the U.S., equities in international, their bonds. They don't care where you invest. If the market goes down 20% and you want to sell, they'll sell it for you. There's no opinion of it. And I think that's really where the advisor can step in and help steady the ship, help explain that markets run through cycles, and you need to add to things at the bottom of the cycles, prune the profit at the top of the cycles, and not react to what the general marketplace. There's a lot of research that you and I look at all the time that shows that individual investors' behavior is incorrect. When the market's going up, they're very excited about adding more money. When the market's going down, or as I like to say, when the market's on sale, nobody's coming to it.
Yeah, I can remember in 2000 when I was calling up clients and saying, Cisco is selling at 75 times earnings. I'd say, sell my Cisco? Are you nuts? And I'd say, you didn't know what Cisco was when we bought it, after it went up 500%. And now you're telling me you don't want to sell any of it? It's at 75 times earnings. They're going to have 75% of all the earnings in the S&P 500 justify their price, and most clients listen. But the point is that you've got to be a voice of reason calling people up because they get so excited when things are going well. And that's the time, as you say, that they should be selling some things and trimming, and they get so depressed at the bottom that they don't want to buy, and we can help them to take the proper action at the proper time.
It's a great example of the tech bubble of 2000, and I had a similar story with Apple just a few years ago. Apple a few years ago, they couldn't miss. They came out with the iPad. They came out with the iPhone. They came out with the App Store, and everything they touched went to gold, and everybody was buying Apple, and Apple stock went to 800 and it was trading somewhere around 50 times earnings, and it was just irrational. And I would do public seminars, or I would do public workshop, and I would give the example of how Apple's overvalued. Now's a good time to take some profit, and people would start yelling at me, "You don't understand, I love my iPhone." And I would say, wait a minute. Yeah. I love the products. Yeah. I love the company. Yeah. It's too expensive. No other reason. This is not against the companies. They're innovative. They're smart people. They're hardworking. Lots of cash. They'll continue that. But we pushed the price up too high. And it's really that voice of reason that I think we add the most value, because, as you said, people get. And again, we've talked in previous months about how the sentiment of the public space. Sometimes they feel really good and they go out and spend, with the wealth effect, right? They borrow against their houses, and we see, goods and services left and right. And other times they're depressed, and both of them are wrong, right? The two extremes are wrong. Yeah. And we can kind of help them manage through those extremes, or hopefully help manage them through that extremes. Yeah.
What I thought about when you were talking about help versus Vanguard, you're not going to get a phone call from Vanguard saying, we just paid out a huge capital gain, so look through the rest of your holdings and see if you have some losses, and take those losses to offset the capital gain so that you won't pay as many in taxes. A lot of times I can help a client in some years to avoid taxes that equal the entire fees that they paid me during the course of a year. And that's the sort of thing that's a value added that we can really come into play with our clients and timely, and let them know to start thinking about that in October so they have time to get their house in order. Maybe they don't have all their assets with you or me, but they can look around and find things that are down and sell them and help on the taxes.
I mean, taxes are very important, and if you're looking at a client's entire net worth and what their income sources are and how they're managing, you can help them do some tax planning, just like you talked. Make sure that you don't buy corporate bonds in a taxable account, and you don't buy municipal bonds in a retirement account, right? You make sure they don't do those things. But I think, again, that's why I think Vanguard is a great example, because they've come full circle. A few years ago, they started issuing these Vipers, which are ETFs, and they have actively reached out to the financial advisor community and saying, hey, look, we like the service that you're offering for your clients. Use our investment vehicle because we do keep fees down. We do keep our investments simple. So, they're in line with that. So I think I think I see the industry coming together, right?
I do too, And the fees, I think if you're creative working with a client, you can say, okay, you have these municipal bonds that you're going to hold. It's a ladder. You're going to hold them forever. You've got the ExxonMobil that your grandfather gave you that you don't want to sell this many shares of it. Let's put those over in an account where they sit there and you're not going to pay a fee. And then we'll put a client in a fee-based account where they pay 1% over here. So maybe their net costs are down below 1% overall. So we're taking good care of the client, and for the costs that we're giving them, even with the low interest rate environment where they expect to make 7 or 8% a year over the long haul in stocks and maybe 3 or 4% in bonds, if we're charging 0.5% or 0.75%, that's well within the realm of, especially for people who don't have time to pay attention to this stuff. And so the net benefit is definitely worth the cost.
Absolutely, and that 1% is a great Mason-Dixon line, right? And I said to clients, and it's exactly how, when we talked about this, is exactly how I set up the portfolios. In one bucket, we don't have any fee on that account, and it is what's doing what it is. And then the one that we're actively managing, we put approximately 1% fee on it. So let's say it gets down to 50 to 75 basis points. But I always say, what? Evaluate us based on 1%. It's just so much easier. On the whole, did we add 1% value to your portfolio? Did we add 1%? Did we save you 1% of your time for taxes? Did we give you 1% more peace of mind? Did we do these things? We're the ones there. When you call in, we're picking up the phone. When we're sitting down for our either 6-month or annual review, we're going over and say, hey, look, this is the world's at. The world's not ending, or the world's not going to keep growing to the sky. It's somewhere in the middle, and we're going to help you see what's going on in the overall world. Answer the questions. It's funny, you talked about taxes, but most people don't understand the amount of additional taxes that have been layered in to our tax system for a number of reasons. And just to explain to them, and I remember in the beginning of this year when we started doing 2013 taxes, sticker shocks all over the place by clients. Oh my gosh, why am I paying so much in taxes? Well, let me show you all the taxes that went up. And when you walk them through that, they get okay, I understand it. What are we doing? This is why we're putting more money into municipal bonds, and yes, this is exactly it. This is the direction we're going.
It was fun finally in 2013 to apologize to clients that we didn't have any losses offset because we had gotten those out of the way in 2009 and 10. So so some people with very high salaries got hit 25% on capital gains. But on the other hand, when you have something, as you were talking about Apple, if somebody had a cost basis on Apple of 20 and it had gone up to 700, my goodness, trim it and pay some taxes, because when something's at 50 times earnings, it's not going to go up 20 times again, and it may not go up. It may go down for a while from there.
And you're right, Charlie. I mean, that's and I think, and I've talked about this before. I firmly believe our friends in the financial media do not help the individual investor, because when things are going up, they're cheerleading. And when things are going down, they're saying the world is over. And so they're almost igniting the worst behavior. When things are going up, keep buying, keep buying, keep buying. When things are going down, keep selling, keep selling, keep selling. And I often tell clients that, these shows are great because all you have to do is watch them, and whatever they're doing, do the opposite.
Yeah.
And you can do pretty well.
Right. Now, in fairness to some of our viewers and listeners out there, if someone has retired and they love the stock markets and they get up and they watch CNBC and they read 10 magazines and they love what they do for every minute of it and they love to rebalance their portfolio for laughs, well, maybe they don't need us.
Right.
There's certain investors who just don't need us. And as long as they have the emotional stamina when the market's down to not panic, and they don't need any help and they don't need to talk to someone else, maybe they join an investment club that'll help them to not panic at the bottom or whatever. But the point is, there are some people out there that don't need us, and there are some people that do need us. And the question is, are you one of the people that thinks you don't need us and you really do? And you don't find that out until the 2008 situation.
Yeah, I think you're right. I think 2008, there were a lot of people that got scared, and it was a scary time. It was a lot of unrest. We didn't know what was going on until we found out the facts. But this too shall pass.
Yeah.
Is a great word to use both on the upside and the downside. And I think it's actually one of my worst times in this industry was actually 1999. Now, 1999, the stock market was giving double-digit returns. You mentioned Cisco. NASDAQ was giving almost triple-digit returns.
Yeah.
And I was advocating lowering exposure to technology, lowering exposure to the stock market because things are unsustainable. And I remember very clearly people telling me, you're crazy. You don't know what's
Sell my Sun Microsystems at 70? No, let's wait till it's at 3 and then sell it.
WorldCom.
Yeah.
No one wanted to sell WorldCom. Bernie Ebbers was a genius. He was just taking over the world. And so it bothers me that, people can react to that. And again, the media jumping in on that, saying, during the internet bubble, they brought out people saying how great Cisco was, how great Sun Microsystem was, how great Pets.com is, and it boggles your mind when again we study this closely. We've been doing this for decades now, and we see these cycles repeat them. If you remember the Nifty 50s, we see it repeating time and time again, and it bothers me that people just don't have the time, especially in today's world. You just don't have the time with the constant barrage of information you're getting over and over again to decide what's right and what's not right.
And every 5 years, somebody will come out with something that's foolproof, where derivatives will protect the downside, and we can stay long, and we'll use these. And of course, when it all blows up, they realize that doesn't work, and you're back to the meat and potatoes. Buy good companies, buy high-quality bonds, buy things at the right time when they're out of favor. And that's what's worked for 100 years, and that's still what's going to be working in 25 years, in my opinion.
I jokingly say, buy low, sell high is a good strategy.
Yeah.
It's hard to implement,
Yep.
but it's a good strategy. And I think when we get into these low periods of time, you really see a lot of panic in the general public. You see, and I don't know how you feel about this, but we jump on data points as if they're the end-all be-all. When the unemployment number comes out, how's it going to affect the market? Well, I'm not sure how it's going to affect the market, but Coca-Cola is still going to try to sell Coca-Cola, whether the unemployment number is at 6%, 16%, or 3%. Yeah. They're still trying to figure out how to sell more Coca-Cola or what other beverage we want to consume. ExxonMobil is still going to pump out gas and refine it and put it into their stores, and they're probably going to throw some Snicker bars and Coca-Cola in there too. So I think that we often look at these data points that the government issues, and also I always remind clients about the government reissues these numbers every 3 or 4 months. So the number they're telling you now is going to change 3 or 4 months ago.
Or even if someone absolutely nails a number, recently an unemployment number dropped dramatically, 0.3 of a point, and it was the lowest in years, and the market was down at the end of that day. So even if you think you can predict what it's going to be, you don't know how the market's going to react to it because there's so many other factors involved.
Yeah, and that's my point, is there are so many factors, and to try to whittle it down to one number or one is foolish. And again, our friends on CNBC, they're very good at that. They take that number and they run with it. That's for sure.
Let's drill down into a couple of particular issues. I get client calls sometimes asking me, should I buy an annuity? Let's say you get a call from a 70-year-old client saying, should I buy an annuity? What do you tell them?
It depends, right? First thing I explain to them is that annuity is an investment surrounded by an insurance. So they understand that this is not a pure investment vehicle and that there are costs with each layer. So they have to be very concerned about the cost, and I often say that annuities are like buying a car. Every feature you put on is going to cost you more money, which takes away from your return. Now, if you're using an annuity to create some type of pension for you, or some monthly distribution or quarterly distribution, and that works for you, and you cannot do that in the marketplace. And what I mean by that is you can't put together either a mutual fund portfolio or equity portfolio and have the same capabilities to get the same yield that you're looking for. Annuity, it might be the right thing for it. I don't think, like our industry does like to say, I don't think everyone should have an annuity.
Yeah, I have the feeling sometimes if someone has quite a bit of their portfolio in tax-deferred accounts and quite a bit in taxable accounts, they can make everything work without using an annuity.
Exactly.
There are some people who don't have any tax-advantaged accounts, and they might want to consider an annuity, but boy, they should do their homework and they should watch what the costs are before they jump in.
Fees matter.
All right.
Fees matter.
And
what about, there's other vehicles, and we kind of touched on them. Clients talk about, there's mutual funds, and there's the A share and there's the C share. And is one better than the other, or how does it work?
Well,
or how do they work?
I think it's important to explain to a client and then get feedback from a client, what are we trying to do with an investment? Now, as you were talking about earlier with Vanguard, they don't have to worry about A shares and C shares. They have no load, no help.
Right.
So if someone needs our help and we're going to try to put them in the right investment, well then A shares have a lower annual expense ratio, and that's a wonderful feature. If you're putting a relatively small amount of money in, let's say $50,000 or less, the unfortunate part is you're going to get tagged with something in excess of 5% upfront cost.
Right.
So only 94 95% of the money is going to go to work for you, and that's bad.
Yep.
So in general, I like to encourage people, if you're going to get into A shares, to put a fairly large amount of money into those so that they can whittle down that load, or in the case of someone putting $1 million in, there's no load and they still get the A shares. But if someone's investing, let's suppose that they think emerging markets are out of favor right now and that they know that these take these wild rides up and down, well then they may want to use a C share, which has a higher annual expense ratio, but 100 cents on the dollar goes to work. And then if you're right, and emerging markets go from 10 times earnings to 15 times earnings plus the growth in the earnings, so you've made 60% in 4 years, then you want to exit that after only 4 years with the higher annual expense ratio, so you still came out better than if you'd bought the A share.
Right.
The problem is if you buy a C share and you decide you like that fund and you hang on to it for 10 years, now in hindsight you should have bought an A share. So it's a little bit complicated, but it's important to make sure the client understands.
It is a little complicated, and I would piggyback on that in two folds. One, there are using the C shares, if you're actively managing your mutual fund portfolio, is probably a better advantage because, again, if you're going to hold it for longer than a year, which if you're not investing for longer than a year, you shouldn't hold it, right?
Right. Oh, yeah.
But if you're going to hold it, it's going to cost you less to have that fund than have the A share, especially given the dollar amounts. Two, if you're using some type of systematic investment approach where you're just taking money on a monthly basis, you're in an accumulation fee, clearly the C share works out far better for you because you can add small increments of dollars and you don't get this large fee up front as you talked about. And three, there are many money managers today, American Funds being one of them, that over the course of that 10 years, they actually convert it to an A share, or so they work within that. That works out for them just fine.
Now, one other feature that has been occurring in the last 3 years, fee-based accounts, you can now get institutional mutual funds inside of a fee-based account. So let's suppose that someone has a portfolio where they have some stocks that they want to own. They have no expertise at all in small cap type of stocks, no expertise overseas, but they want to work with their financial advisor to pick out stocks and sectors they're comfortable with. Well, you can use some institutional shares in emerging markets or small caps or whatever within that portfolio. You do have to add the fee that the broker is charging plus the fairly low expense ratio. But if it's a relatively small part of the portfolio and it helps you diversify, that's another way to skin that cat.
And I think the bottom line when it comes to the different investment options and different vehicles clients use, I think what you said earlier resonates. Your advisor obviously should have your best interest in heart. They should look at your total portfolio and your total goals and objectives and help you build a strategy that's going to get you there. Clearly, they should keep fees in mind, and they should be upfront with all those fees so the client's completely aware of it. And if there's investments that are longer term, as you mentioned, bonds that you're never going to sell if you have a ladder bond portfolio and or the stock that your dad gave you, clearly they should not charge a fee on that. Or in my case, some clients I work with have highly concentrated stocks because that's their companies that they work with. Clearly that's not an area that we should put a fee wrapper around. And then the other side of the equation is the actively managed investments that they're helping to do it most tax efficiently, help you navigate the marketplace and the different cycles that we're in. Clearly a reasonable fee should be assessed on that. And then the bottom line is when it's all said and done, the client's best interest should be first.
And one of the things I try to make sure my clients understand is if they have a 401k that's away from me where they work, I'm only too happy to look at that. It's a benefit for me to look.
Absolutely. Because
I can fold it into what we own and make sure there's not duplication, that we are properly diversified. And I'll advise them if I see what opportunities are available in that 401k. And so I'm not getting paid for that part, but it's part of the value added that we can provide. Right. And I really get upset if clients don't take advantage of that, because now I'm being asked to invest, not really having a total picture of their portfolio. Right. And we have a thing called Envision now, and I'm sure you have a similar type of thing, that causes us to have a total portfolio overview. And when clients see what we're doing in that, then they gain confidence, and they'll send us every 6 months a report on their other stuff so that they know that we're still properly diversified.
Yeah, that's again another value added that advisors can be. And again, it's a difficult investment world out there. It always has been, always will be. Plain potatoes, meat and potatoes works, and I think financial advisors do add value to people's portfolios, if you will. Well, that was a great show, Charlie. Thanks for all your insight there. Our next week's guest is Chuck Stieg from SFG Advisor, and Chuck is an expert on executive compensation, and he's going to tell us all the ins and outs and nuances of it, so make sure you stop back for that show. Additionally, Money Matters is now available in Philadelphia on Comcast 66 and Fios 29 every Wednesday at 11 a.m., and that's brought to you by the Philly Cam, and we look forward to working with them in the future. Until next time, your money matters.
Thanks.